Welcome to the Deep Dive. We're TalkTickers, and we're here to cut through the noise of earnings calls, basically give you the key insights without the jargon.
Exactly. Today it's Xunlei's Q1 2025 earnings call transcript.
Right. We're going to unpack the results, figure out what's driving the numbers, and see what management's really focusing on going forward. Our goal is to give you that clear picture fast.
Okay, so let's start with the headline numbers Xunlei put out for Q1.
Let's do it. So total revenues, they reported $88.8 million for the quarter.
And that's up 10.5% compared to last year. So, decent top line growth.
Yeah, 10.5% is definitely growth. But what about the bottom line? That's where things often get interesting.
Well, they do here. Xunlei actually reported a net loss of $7.9 million for Q1.
A loss. Okay, how does that compare to last year?
Big swing. Last year, same quarter, they had net income of $3.6 million.
Wow.
Yeah. And even if you look at their non-GAAP number, the adjusted net income, that was $1.1 million, still way down from $4.5 million last year.
So revenue's up, but profit turned into a loss. That's quite the shift.
It is. So the first reaction is, okay, growth is good, but something's definitely pressuring profitability.
We need to dig into that. Where did that revenue growth actually come from? Let's break down those segments.
Right, because the story isn't uniform across the business at all. Their subscription segment brought in $35.7 million. That's up 7.7% year over year. Pretty solid.
Okay, 7.7% for subscriptions. What else?
Then you have live streaming and other services. This part was really strong, $28.4 million in revenue, which is up a huge 56% compared to last year.
56%. Okay, that's clearly a major growth engine right now. What's the third piece?
The third piece is cloud computing. And, well, I went the other way. Revenue there was $24.7 million, but that's down 18% year over year.
Down 18%. So you've got this massive growth in live streaming, decent growth in subscriptions, but they're fighting against a pretty significant decline in the cloud business.
Exactly. That contrast is really the key takeaway on the revenue side.
Let's stick with the subscription part for a sec. Did they talk about subscriber numbers or, how much they're making per user, the ARPU?
They did. Total subscribers grew 5% year over year. They ended the quarter with 6.04 million.
Okay, 5% subscriber growth, 7.7% subscription revenue growth. That seems broadly consistent. What about ARPU?
This is where it gets a bit strange, honestly. They reported ARPU, average revenue per subscriber, of RMB 14.9 in Q1 this year.
Okay, 14.9 RMB. And last year?
Last year, Q1 2024, they reported RMB 39.5.
Wait, hold on. It dropped from almost 40 RMB down to under 15. That's a massive drop. But you just said subscription revenue was up. How does that work?
Right. It seems contradictory. And their explanation, well, the stated reason on the call was, and I'm quoting loosely here, due to the increased proportion of premium subscribers, which have higher average revenue per subscriber.
Wouldn't more premium subscribers mean higher average revenue, not lower?
Exactly. That's the puzzling part. The stated reason suggests ARPU should be going up, not down dramatically. So based purely on the transcript, there's a lack of clarity there. The numbers in the explanation don't seem to line up.
Okay, that's definitely something to flag. Moving on then, profitability. Costs must have changed quite a bit with live streaming booming and cloud shrinking.
For sure. Cost of revenues increased. It hit $44.4 million, which works out to 50% of their total revenue for the quarter.
50%. How does that compare?
It's up. Last year, it was $37.1 million, which was 46.2% of revenue. So costs grew faster than revenue.
And why was it, did they say?
Yeah, they attributed it mainly to higher revenue sharing costs, specifically in that overseas audio live streaming business, which, kind of makes sense. If that part is growing 56%, you're likely paying out more to the streamers or partners driving it.
Right, that follows. So higher cost of revenue, what did that do to the gross profit and margin?
Well, gross profit in absolute dollars actually went up a little bit, 2.9% to $44.1 million. But because costs rose faster than revenue.
The margin went down.
Exactly. The gross profit margin fell to 49.7% from 53.3% last year.
And what was the main drag on the margin, according to them?
They pointed mainly to the decrease in the gross profit margin of the cloud computing business. So even though live streaming and subscriptions helped the total gross profit dollars, the lower profitability in cloud pulled the overall margin percentage down.
So that cloud segment is a double whammy, declining revenue and declining profitability per dollar. Ouch.
Yeah, that seems to be the story.
And
then you layer on the operating expenses.
Right, OpEx. This tells us where they're putting their money. R&D, sales and marketing, G&A. What changed there?
Okay, R&D was $18.7 million. That's about 21% of revenue. It was up slightly in dollar terms from $17.6 million last year, but actually down a bit as a percentage of revenue. They said that was mostly higher labor costs.
Okay, R&D fairly stable as a percentage. What about the others?
The big mover was sales and marketing. That jumped significantly, $15.5 million this quarter, which is 17.5% of revenue.
17.5% was it last year?
Last year it was $10.1 million, or only 12.5% of revenue.
That's a huge increase in spending. Why the big jump?
They directly linked it to spending more on marketing for user acquisition, specifically targeting the subscription business and that booming overseas audio live streaming segment. So investing heavily to fuel that growth.
Makes sense strategically, but obviously impacts the bottom line. And G&A?
G&A was pretty steady, $11.8 million, or 13.3% of revenue, slightly up in dollars from $11.1 million, but down a bit as a percentage, similar to R&D.
So the real story in OpEx is that big ramp up in sales and marketing spend.
Absolutely. And when you put it all together, the lower gross margin we talked about, plus that big hike in S&M spending that explains the swing on the bottom line.
Right. How did it impact the operating income?
It flipped it. They reported an operating loss of $1.9 million this quarter. Compare that to an operating income of $4 million in the same period last year.
And that operating loss flows down to the net loss we started with.
Pretty much, yeah. They said the net loss of $29 million was primarily due to that operating loss, though it was partially offset by some other income, non-operating stuff.
Okay, so that connects the dots on how they got from 10.5% revenue growth to a net loss. It's the cloud drag on margins, plus that conscious decision to spend more on marketing for the growth areas.
That's the picture painted by the call, yes.
What about their financial health? Cash on hand, did they discuss that?
They did. As of the end of March 2025, they had cash equivalents, and short-term investments totaling $274.6 million.
$274.6 million. How does that compare to a year ago?
It's down a bit. A year ago it was $287.5 million.
Okay, so they used some cash. What for?
They listed a few things. Paying for that acquisition of Hoopu they mentioned, spending on their share repurchase program, and paying down some bank loans. They did say this was partly offset by cash coming in from operations.
Ah, the share repurchase. Are they actively buying back stock?
Seems like it. They authorized a $20 million program back in June 2024, running for 12 months. And by the end of this quarter, March 31st, they'd spent $6.5 million under that plan.
Okay. How much of that was in Q1 itself?
$4.9 million was spent just in Q1 2025. So yes, they were pretty active buyers in the quarter.
Good to know. All right, looking forward then, did they give any guidance for Q2?
Yes, they provided revenue guidance for the second quarter. They're estimating total revenues between $91 million and $96 million.
$91 to $96 million. What does that imply sequentially from Q1?
Well, the midpoint of that range, let's say $93.5 million, would be about a 5.3% increase compared to the $88.8 million they just reported for Q1.
So they expect the top line growth to continue sequentially into Q2.
Yeah.
Beyond just the numbers, what did management say about their overall strategy, especially with these different parts of the business moving in opposite directions?
Yeah, the CEO talked about this. The priorities are really about driving growth through innovation, but also, and this seemed key, actively looking at business restructuring opportunities.
Restructuring opportunities? That sounds like they might be thinking about that cloud business.
Well, you have to assume it's related, given the performance.
Yeah.
They also pointed to the Hoopu acquisition back in January as part of their strategy to broaden their market presence and diversify. So building up the stronger areas while potentially rethinking the weaker ones.
And AI. Seems like everyone talks about AI on calls these days. Was that mentioned?
It was, particularly in the Q&A session. They confirmed their AI team is working on several applications using, the big mainstream large language models.
Did they give any specifics, like what kind of applications?
They mentioned three things specifically. An AI-powered auto-editing tool, some kind of AI-containing app, and an AI-integrated toolbar solution.
Okay, interesting. Are these launching soon?
They said these are currently under development and testing. They'll launch them when they feel they're ready. So it sounds like it's still in progress, but definitely an area of R&D focus.
Right, which ties back to that R&D spending we saw earlier. Okay, let's try to pull this all together for the listener. If you had to summarize the story Xunlei told on this call, what's the core narrative?
I think the narrative is this. Xunlei has some really bright spots, right? Subscription growth is solid, and overseas live streaming is, frankly, booming. That's driving overall revenue growth.
Out.
But they have this significant drag from their cloud computing business. It's shrinking, and it's hurting their overall profitability. pulling down gross margins. This, combined with a big, deliberate increase in marketing spend to fuel the growth areas.
Led to the net loss.
Exactly. So management's response seems to be acknowledge the cloud problem, explicitly state they're exploring restructuring options to, quote, minimize the impact while using their quite healthy cash balance to double down on the winners through marketing, M&A like ARPU, share buybacks, and investing in future tech like AI.
So it's a pivot strategy in action, funded by their balance sheet, trying to navigate away from the troubled segment.
That's how it reads from the call, yeah. The spending aligns with the strategy they laid out.
Okay, very clear synthesis. Now it's time for that part of the deep dive, the segment that is absolutely 100% not financial advice. Seriously, folks. Disclaimer. What you're about to hear is purely for informational and entertainment purposes. It is not investment advice. It's just us kicking around a highly speculative, maybe even outrageous, but perhaps plausible idea based only on what we heard in the Xunlei Q1 2025 earnings call transcript. Do not trade based on this, please.
Okay, disclaimer delivered. Let's put on the speculative thinking caps. We've talked a lot about the tension in Xunlei's results. You've got the cloud business down 18%, management talking about challenges, pricing pressures, wanting to minimize the impact, and exploring restructuring opportunities.
Right, that restructuring comment really stands out.
It does. So here's the outrageous but plausible idea. What about a pear trade? You go short. Maybe a basket of smaller, pure-play cloud infrastructure or services companies, the kind that might be facing similar market headwinds without Xunlei's other businesses.
Okay, short the vulnerable cloud players. And the other side of the pair.
Long Xunlei.
Long Xunlei. Despite the net loss and the cloud drag, explain the thesis there.
The speculative thesis is this. Xunlei has those growing subscription and especially live streaming businesses. They have a ton of cash. Nearly $275 million. They're actively buying back shares. And they explicitly said they're looking at restructuring.
So the bet is they actually do something about the cloud business.
Sort of. The bet is they have the means and the stated intention to potentially address it. Maybe they sell it, maybe they spin it off, maybe they just shrink it significantly. If they do that, they remove this major anchor dragging down margins and sentiment.
And they can use their cash for
funding growth in the successful parts, doing more acquisitions like ARPU, buying back more stock, things that could be seen positively by the market. It's basically a bet that Xunlei, because of its diversification and balance sheet, can navigate this cloud downturn better than smaller, less diversified players, and that a restructuring could unlock value.
So you're betting on a successful strategic pivot funded internally that makes Xunlei look better relative to pure play cloud companies also facing pressure.
Exactly. It hinges entirely on them executing some kind of restructuring effectively. Highly speculative, depends entirely on interpreting those management comments and the numbers from this one call. And one last time.
Not financial advice. Got it. That was definitely an interesting thought experiment based on the call details. Thanks for walking us through Xunlei's Q1.
You're welcome. Glad to do it.
All right, so let's quickly recap the key takeaways from this deep dive on Xunlei's Q1 2025 call. We saw solid overall revenue growth, really powered by subscriptions, and especially that booming overseas live streaming segment.
But that growth was offset by real challenges in the cloud computing business, which saw revenue decline and drag down overall profitability.
Right. And that, combined with increased investments, especially in marketing to fuel the growth areas, resulted in a swing from a net profit last year to a net loss this quarter.
Management seems aware of the issues. They're talking about restructuring, investing in growth through M&A and AI development, and they have a strong cash position, plus an active share buyback program.
And just to be crystal clear again, this analysis is based only on the earnings call transcript we reviewed. It is not financial advice.
Definitely not.
So here's a final thought for you to chew on. Given that stark difference between the growing parts of Xunlei and the declining cloud business, what kind of restructuring opportunities could they realistically pursue to minimize the impact? And how fast could something like that actually change the company's bottom line and maybe its whole story?
Something to ponder.
Indeed. Thanks for joining us for this deep dive.